Hey, Bruce. Nice to see you again.
I have to try to replace Howard Marks.
Howard is indeed a hard act to follow, right? But I know you'll try. Here's where I'd like to begin. Bruce, it occurred to me yesterday, or perhaps it reoccurred to me because it's something I've known for a long time, that you've been the CEO of Brookfield for 23 years. Here's something to think about. That's not just longer than Harvey Schwartz at Carlyle, Mark Rowan at Apollo, Joe Bay and Scott Nuttall at KKR, John Wrinkle-Reed at TPG, or Mike Arrighetti of Ares. It's more than all of them combined.
That just obviously means I'm old.
Well, my intention, of course, is not to make you feel old, but that does make you one of the longest tenured CEOs in what we now call alternatives or private assets, the businesses that Brookfield is in. So maybe we can start with a bit of reflection on that expanse of time. What about this industry? And some people here have been along for the whole ride, which is incredible, but what about this industry has changed the most since you became CEO in 2002?
Everything. No, look, I would say the following. The business at that time was nascent. It was mostly real estate focused. It was private equity had started raising money. And what didn't exist was infrastructure and large scale private equity and all the other businesses that we're in today, and obviously private credit. And I think there was never a breakthrough. But every single year for 25 years, every single year for 25 years, because it's been longer since from before when I was CEO. Of course. Every single year for 25 years, more investors understood the fundamentals of why you should invest in private assets. And leave aside whether it's private equity, alternatives, et cetera, infrastructure, real estate. Private assets take away the confusion of the stock markets and ensure that you don't get distracted on a day-to-day basis by volatility that means virtually nothing to your investment. You get paid for some form of illiquidity, so you earn a higher return. And the businesses that you buy or that somebody buys for you can act in ways that are only fundamental decisions. Companies in the stock market often have to make decisions which are not fundamental investment decisions. They have to play to the market. And in private markets, those three things increasingly every single year became evident to investors around the world. And it was obvious those three things made sense, but it just takes time for it takes time for people to, especially institutional investors, to understand that, get their committees comfortable with it, get their board comfortable with it, make allocations to it. And over that period of time, there were ups and downs in the market. And what happened is private assets performed unbelievably well. And now we can look back, infrastructure is maybe the best example. There is no better asset class that's performed broadly, infrastructure, renewables, et cetera, than infrastructure, and it's gone through cycles, it's gone through major crises, and it's performed. And I think that's what happened. They got into it, they got comfortable, and it's performed. And that's really all you need in investment management. You need performance, and we can probably talk about this later, but what's happened is we're not even started yet because institutions are still low allocations to what they should have. Like on average, they're probably 15%. Some are 50, but on average they're 15, and it should be 30, 40, 50 in many of these institutions. And retail wealth and individuals are zero, quote unquote, zero.
We will be getting to some of that. Brookfield itself has undergone something of a transformation over that period of time too, not just in terms of what it invests, which you touched on a moment ago, but structurally as well. What in your mind, again, you're the guy who's been at the controls for that long, What do you think of as the biggest and most significant changes that this firm has undergone?
Look, we started as just doing these things ourselves. And the asset management
Quietly,
business...
I should add, without a lot of fanfare, right?
But the asset management business we created was merely, the way we looked at it, it was merely we wanted to do the things we did, but expand the geography of doing it and do it in larger ways. And one can either own 100% of something themselves, or they can own 5 or 10% of something and have a lot of friends. And that's what the asset management business facilitated with our capital. And of course, now looking back, 25 years later, it created an incredible business in itself as an asset management business. But when we started, it was merely just to diversify and globalize and bring capital into the business without taking undue risks and have partners. And I think maybe the most important thing that we have that differentiates us from some others is that we think that way still about our business investments. These are investments that we make with part of our capital and that we have partners with us. And that's different than raise some money and invest it for other people. And that I think pervades what we have. And maybe, I'm going to turn the question around, maybe the most important thing that we have is still that culture within the organization to ensure that we keep that ethos.
I could, I suppose, ask you about your own transformation, but the truth of the matter is that you haven't, at least physically, changed that much. I went back and looked at some photographs from Bruce in the early 2000s, and apart from maybe an ever so slight change in hair color, you look identical today to, you can trust me on this, or check it yourself. So I'll phrase the question differently. What are the most important lessons that you as the CEO have learned over that almost quarter century?
I think I knew before. I always was a value type investor, and I think I knew before it was really important to compound wealth over long periods of time. But I think in the last 35 years, I'd say the most important thing that has been continuously emphasized to me and is more ingrained in me today than it was 35 years ago is that long-term wealth creation is about earning reasonable returns over very long periods of time. Find good businesses, good people, good investments, keep them, and just keep compounding. And I think that's more important today. And I'd say that's probably the thing that's ingrained. It's very, very hard. And I think what it is if you're outside of a company looking in, you see a stock. If you're inside of a company looking out, you own the business and you don't really care what the stock does. And I think that's probably the biggest, that's something that's really important for people to understand when they're making investments, because you just own a fractional portion of a business.
It's useful to have you here and extract, if you will, a global view. You recently described what Brookfield does as, one, identifying big global trends that are going to affect the economies and the industries in which you operate. Two, package them into products that can attract capital. And three, deploy that capital quickly and at scale. So for the benefit of those who might not have either heard that or understand where you see these opportunities, what are the biggest, most important global trends that you're investing behind today?
I kind of like the way you said that. Maybe you should do that for me next time. Those are a good way to describe what we do. There are a few trends that are happening in the world today that are almost unlike anything that's occurred in the investment world ever. That sounds like a dramatic statement, but the amount of money that's going into the power sector to both make it cleaner, but just sheer building power is so big. And I'm Connor and the team will talk about the renewables business afterwards. But we're talking fives and tens of trillions, and this is unlike anything. And we were flat power usage for a long time, and now it's going to double in most countries of the world, and that is a dramatic thing that's going on. It's going to affect everyone and everything that's going on in the world. on top, that was happening, and on top of that, that assumed cloud adoption was going to be increasing. And now with artificial intelligence stacked on top of that, the amount of money being put into, I'll call it, the end output is compute capacity. Wherever you're investing along the compendium, again, is 5/10 of trillions. And this is being funded by governments, it's being funded by hyperscalers, it's being funded by sponsors. But there's never been an investment trend. These are these data center AI factories that we're building are $50 billion a piece. And like an office building in New York City, they're large. We used to think they were large, and they're $1 billion or $2 billion. Not to shrug at $1 billion or $2 billion, but this is the scale of what's going on. It's unprecedented. The good news is it's being funded by governments. It's being backed by governments and the largest, most successful companies on the planet, the technology titans. And that's really important when you're dealing with these sums of money.
I'm going to come back to that in a moment. But in the interim, this is a huge opportunity. I think Brookfield has sized it at in the order of $7 trillion. I'm speaking of AI alone, not the power build-out. And I can understand why it excites you on any number of levels. It excites and maybe at the same time scares all of us. There's so much there for a firm like yours, whether it's building AI factories or the compute infrastructure or the power supplies and the transmission and all of the other stuff that comes along with it. Is there anywhere, in that you described it as a continuum, that excites you most, you think is the single best investment opportunity for a company like this?
I'd say the advantage we have is we've been doing this a long time. We've been building power plants a long time. We've been building data centers a long time. We've been developing real estate a long time. And the combination of those three things is really what this is. And fortuitously, we ended up at the intersection of what really matters today. What is the most difficult thing is this is the first innings of a very long 15, 20-year build-out. And nobody has done this before. Nobody. And we have all the pieces, but nobody has produced compute capacity in the scale that we're going to soon do it. And we're as well suited as almost anyone in the world to do it because of our access to all those skills and capital. But we're in the early stages of it, and execution is so important because we're dealing with the global best and countries, and this is really serious. And so the biggest excitement and the biggest worry is execution. Like everyone can say they're going to get into this, and it's just not easy. So we have everything that you can do it, but the execution of these things is really, really important.
So my boss, my ultimate boss, Mike Bloomberg, is fond of saying to people when they're just about to go and do a big job, I'll paraphrase, don't screw it up. How do you not screw it up?
Look, the good news is we have 3,000 people that build power plants for us. We have a huge data center businesses. We've been raising capital in this way for a long period of time. We have relationships with all the hyperscalers, many of the governments. It's just knitting all that stuff together. And I would just say we are going to make small mistakes. And we're always we're not trying to make small mistakes. We'd like to make none. But we allow small mistakes as you go along. And what we can't do is ever commit ourselves to do something that could damage ourselves in the long term for short-term profit or success. And probably the one thing, there are many others, and many of the things we do, you'll see press releases out of, because they're interested in short-term success. What we're interested in is making a lot of money over the long term, not making a little amount of money in the short term. And I think that's probably the single difference. So we're being very careful and methodical because our relationships with the global best are really, really important, and we need to get it right when we deal with them.
You're absolutely right, of course, that no one has ever tried to build computing power at this scale and so broadly geographically ever before. However, we have seen something similar-ish. We were both around in the 1990s for the telecom boom, and the level of enthusiasm and this concentration of hot stocks, as some of you here may recall, not to mention the hockey stick charts from people like George Gilder at the time, were similar to what we're going through today with AI. But you and I were both also around, goes without saying, because he was the CEO in 2002, in the early 2000s, right? And the subsequent bust of the telecom boom. There's so much money chasing this opportunity, deals backed, as you pointed out, by checks in the hundreds of millions of dollars, seemingly every week. Could this too not prove to be an overbuild? Not a flawed thesis, but an overbuild that ends in tears for the people who financed it?
So the amount of need is so large, and the execution of getting it done is so hard. There is a moat around the ability to develop. Many of the things are press releases. They will not get developed. It's not easy to get these sites up and running, get them connected to fiber, get the power, put in chips and make compute capacity. So the first point I make is this is not that easy to do, and therefore there will be lots built, but not as much as you think. Secondly, that I'll call it the global crossing era, was building fiber around the world. The single difference is really important to make. They were building fiber with no contracts. And they were building it on the hope that they were going to get customers to fill the transmission lines because there was an endless amount of success coming. The difference today is this is being led by 7, 8, 10 technology companies that on average have a $1.5 trillion market cap. This is being led by credits as large as countries. In fact, the second component of it is countries. So it's being led by countries, our sovereign AI strategy, and technology titans. For us, it is all contracted. Therefore, there's always risk, but the risk you just mentioned is not going to happen. Now, are there people out there that will make mistakes? Of course. Where there's a gold rush coming, there are always people that don't know how to execute, will get into it and will make mistakes and blow their feet off. And there are people that will take counterparties or contracts which won't work out to be what they thought. And they'll get caught, in Warren Buffett's saying, as the tide goes out. So we're not going this way all the way. It's always like this. That's the new backbone of the global economy. And as you know, 50% of the things that we have today didn't exist as an investable asset class 20 years ago. That's an amazing statement in itself. And this will continue to transform because it changes every day.
A very different kind of trend in private assets is what we might call retailization, the growing flow of retail capital into alternatives. Some of that is thanks to regulatory change. Some of that is thanks in no small part to good marketing. Brookfield, for sure, was an early leader in the retailization trend because it raised permanent capital, right, in the form of publicly traded equity vehicles, when, so far as I can recall, nothing like it existed. They're right here.
We have 3 here today.
So given that experience and the knowledge you've acquired as a result, how do you see that retailization trend playing out in the private asset industry?
So I think the next 20 years will be just like the last 20 in institutional accounts. Every single year for the next 20 years, more
retail money.
More individual investors will understand the benefits of private assets, and they will start to allocate part of their money into private assets. I'm quite confident that if they do it with people that are good, they'll have success. And the next year, 3 years later, they'll allocate more. And 20 years from now, we'll look back and institutional or private individual accounts will have 30% of their assets in private markets. Some will be 80, some will be 50, some will be 20, some may be 0. But I think on balance, it'll be 25%, and it should be more. But it just takes time. But at $20 trillion, we can't properly, the industry can't properly manage that amount of capital anyway. Therefore, what it does is just we still have a backdrop of sovereign institutional accounts allocating to privates. Insurance increasingly is allocating to privates, and retail wealth is the next level, just because it makes sense. I go back to the 3 things I said at the start. It just makes sense, and it's going to happen. And all we have to do, why they can't do it today, is they're not packaged to be able to fit into the structures of retail wealth. And we just need to take the exact things that we do for institutional clients, package them so that they can get fed into 401ks, retail wealth channels, et cetera. And we've been doing it now with high net worth wealth, and increasingly we just need to move further down.
One of the, I guess you could call it, obvious risks in private assets, broadly speaking, is relative to the public markets, a lack of liquidity, and that's an issue in private equity today. Most PE managers, and I suppose you folks are going to hear a little bit more about this, I gather Brookfield is a notable exception, most PE managers are having a rather tough time selling portfolio companies, and they're resorting to all kinds of financial engineering as a result. Howard, who I'm sad is not with us, because this would have been a whole lot of fun, as you probably know, Bruce, has never been a fan of financial engineering, the subscription lines and the continuation vehicles that are so prevalent in private equity today. As he likes to say, you can't eat IRR. Are you similarly concerned about this amount of financial engineering, and what kind of an impact is it going to have on PE longer term?
So I think just to set the table is, if somebody can't sell an investment, leave aside bad businesses. I'm not talking about those. People that had growth investments or tech investments and they made a mistake, forget those. I'm talking about good businesses. Mm-hmm. If you have a good business and you don't sell it and you're not returning capital, I know institutional account X wanted some money back and they expected some money back, but it's still compounding away probably at 14% or 15 or 17 or 12 or 11 or 9. So it's still going up in value. Remember, all they're doing is trying to invest. So we shouldn't get so excited that people aren't selling things. The value's still in those businesses, and they're still getting better, and they're still enhancing value every single day. So I don't get too stressed about that. Second point is, yes, institutional accounts want money back because that's their model. They need money back to fund other commitments. And those that have business models like ours that have access to many sources of capital, have relationships more broadly, are big, are going to win because we can do things that most others cannot. And we don't have to resort to all the things you talked about. But on balance, I don't think there's not bad things going on in the industry. People haven't returned capital. And eventually the IPO markets will come back, and for those that invested in good businesses, the money will start to flow again, and it's happening already. For those that invested in bad businesses, the record's going to be terrible, and they're going to be out of business. And I'm sure, I don't know.
Just the Darwinian outcome.
Yeah, how many private equity firms are in the U.S.? 7,000?
Lots.
10,000. There'll be
More private equity firms than banks now.
There should be 4,000 less. I don't know. They're like the fact is, everyone thought this was simple. Let's start a private equity fund. I'm going to leave XYZ firm and I'm going to start my own. It's not easy. This is hard work. And I would just say it always goes through periods of time when money is free. Everyone thinks they're a genius and they're going to go and invest and start a private equity firm. But what happens in tougher times is things consolidate. And that's every single industry, and that's just what's going on in private markets today.
I said it was a shame that Howard isn't with us, and it's a shame for other reasons too, because Howard knows so much about credit. But now that you and Howard have been in business together for 6+ years, you know a few things about credit too. In fact, the last time that the three of us sat on stage together was the day that you announced the Oaktree acquisition in March of 2019. Feels like a lifetime ago, of course, because it was before the pandemic. As we all know, credit, in particular private credit, has exploded since that acquisition. I remember very distinctly when we had that conversation in 2019, you and Howard both said categorically that this was not about either Brookfield getting a good deal or Oaktree trying to maximize its return to its own partners, to its shareholders. But boy, $5 billion for 61% of Oaktree sure looks like a bargain in retrospect for Brookfield shareholders. Last year, it cost BlackRock $30 billion to buy HPS. Blue Owl has a market cap of $26 billion today. Ares is worth $54 billion. I'm just curious, if you were buying 61% of Oaktree today, knowing what a business it has become, what do you figure it would cost?
So let's talk about the credit business. The partnership that we struck with Oaktree has got us into a whole bunch of things that we could have never done ourselves. We were probably also the first purchaser, quote unquote, of a investment management business.
Big credit platform.
Yeah, there was none had been done, and we came up with a pretty unique model to do it. That's why they came on the team to do it. They've still been partners with us and benefited from that. Remember, we didn't take the partners out. What we took was the public out, which it traded poorly in the market at the time, and probably as their business.
No, returns yields were so low, it was hard.
It probably would trade that way today, but all the shareholders that have been in the business have been enormously benefited with us along the way. What it did for us, though, is it widened our aperture in credit in a very significant way, and now we're one of the few in the world that can offer many, many products through our different platforms, and it taught us. I think we learned a lot on what we can do and what we shouldn't do with buying other managers, and we've added on, like we bought Castle Lake, asset-backed finance lender recently, and partnered with their team as well. And I think we've learned to figure out how to do that. And but there's no doubt the industry continues to grow and be successful.